Hello, everyone. Welcome again to another session with Ted and Moeed. This time we're looking at Apple. Great company. Um, Broken a lot of records. So back in 2018, in August, I believe, it was the first company, public company at least, to become $1 trillion in valuation. And since then, it's doubled to just $2.3 trillion. Just to give you kind of scale of how big this company is, the World Bank did an assessment, and there are 216 companies in the world whose annual GDP is less than the market cap of Apple. So that kind of gives you
Countries, Moeed, not companies.
countries, yes, countries, sorry. So that's 97.3 countries in the world have an annual GDP that's less than the value of Apple, which is astounding. And analysts are saying that they're not going to stop there. Of course, they're going to reach probably $3 trillion in valuation. And if you look at the Q4 results of 2020, they had their biggest sales ever at $111 billion in the last 3 months of 2020. So this is an astounding company to look at, and we're really excited to have a look at their finances. Ted, what did you find out about the business?
Well, so good to see you again, Moeed. I personally am a massive fan of Apple. As they say, once you go Mac, you don't go back. So I have MacBook Pros and iMacs and iPhones and iPads and everything else coming out of my ears. And I sometimes feel that with 5 kids, each of them demanding more and more Apple products, I sometimes feel that I'm a major contributor to their overall profitability. But you're absolutely right. Let's go and have a look at their finances. So here we see the income statement, so the profit and loss account. Now, the first thing we notice, we got 3 years here. So 2018 on the right, 2019 in the middle, 2020 on the left. They have a year end of the end of September. So the number you were talking about, 111 billion of sales, that's in the last year of the last quarter of 2020, which is, of course, the year which was in September 2021. So what we see here is the first one. We see their product sales and so products and services sales and products and services cost of sales. So Apple have divided these into two types. You've got the products, which is like iPhones and iPads and iMac, etc., and then they've also got the services, and that'll be things like Apple Music, iCloud services, and Apple TV, for example. So they want to split that out so you can get a sense of the margin that they're working at for both of those products. Put together, they're operating on about a 40% gross margin. It's actually 38%. And that 38% has been pretty consistent over the years. So you'll notice that a little bit in 2019, they're coming up into for the first quarter and multiply that by 4, which is, I know, a little bit punchy, but if you multiply it by 4, you end up with a company of 444 billion. I'm not sure they're going to hit that, but that kind of gives you an idea that they are starting to grow again. So here's the gross profit. Gross profit is 115 billion. They've got the cost of running the business. Lots of research and development going on in here. They can afford it and they need to. They can't live off the iPhone forever. They know that. We know that. The iPhone's been around for a long time now. Just calling it an iPhone 12 or 13 doesn't necessarily make it any better. So they do need to kind of invent the new iPhone. If you're a fan of the Boston Consulting matrix, they have a cash cow, and they need to be inventing the next new cash cow, effectively the star, we can call it. And then they've got about 20 billion of sales, general administrative. Bottom line, they're earning net profit of $57 billion. Okay, so pretty consistent with previous years. 60 billion, 55 billion, 57 billion. So these guys are earning a lot of they're making a lot of profit. I'm going to come back to the balance sheet in a minute, but before I do, I just want to bounce through the balance sheet and go down to the cash flow. So the cash flow is quite important. This is the movement in equity. Here's the cash flow. So we see from this company that they are generating lots and lots of money in terms of their cash. So we've got the kind of the net profit or the net income, which is 57 billion. But in terms of cash, they're generating 81 billion. So that's a very, very good number. It's a strong number. They're generating lots of cash. What are they doing with that cash? Well, the first thing we see is that they are investing in the future. So we look here, they're investing in the business, and they are also using it in financing. Now, we're going to need to look at these numbers in a little bit more detail because it's not exactly as it appears. So the first thing we're going to look at in the financing activities is these numbers here. So if we look at the payments for dividends, so the proceeds from stock is them selling shares, but this bit here is the payments for dividends and the repurchase of common stock. Okay, so these two numbers here is the way of getting money back to the shareholders. So not only are they paying out dividends, they're buying back their own shares. And if we look at those over the last 3 years, we can see they've been paying a little bit in dividends. I say a little bit, it's about 15 or 14 billion dollars a year. They've been paying a 14 billion dollar a year in dividends, but they've also been returning through share buybacks of anywhere between 74 and 68 billion dollars. So add those two together, 74 plus 14, and you're looking at about 88, nearly 90 billion dollars a year is being given back to the shareholders. But it's not just the dividend, it is share buyback as well, because if they buy back the shares, the value of the shares go up. And as you articulated, we see that in their share price. Just below that, we see the proceeds and the issuance of debt. So these two numbers here, let me just put that in a different numbers, different color so we can see it easily. So these two numbers here, this is really all about debt refinancing. Now, we've covered this on some of our other companies before. Companies borrow money. When they have to give it back, they borrow more money to repay money. That's absolutely fine. That's kind of standard operational procedure for a company, especially like Apple, who can easily afford that debt because they're generating so much money they can cover the interest payments. Don't forget, for Apple, they can borrow at about 2%, they invest at 18%. If you've got spare cash, don't use it to pay down debt that only costs you 2%. You might as well invest it and generate that 18%. Okay, so let's go to the balance sheet, and here is the balance sheet. So usually we look at this a little bit earlier on, and balance sheet pretty straightforward, really. So we've got the non-current assets are in here. So these are the things that we need to run the business. So tables and chairs and plant and machinery, etc., etc. And then the current assets are here, about 144 billion dollars. Okay, so they've got about 180 billion of non-current assets, things we need to run the business, and 144 billion of things which are cash or going to become cash quite soon. They've then got the current liabilities here, about 105 billion. Okay, and very quickly, we now kind of getting used to this, that we always compare these two numbers. So 144 billion of cash or coming in as cash soon, 105 billion of cash, stuff that we have to pay soon. Liquidity is not a problem for these guys, and we've seen they're generating lots of cash. And then down here, we've got the debt. So there's the debt. It's about nearly 100 billion of debt, and then a few other non-current liabilities. So in terms of the overall balance sheet, we can see the equity. Here it is. So the equity is the net assets. That's the assets less the liabilities. It's that 65 billion there. In theory, that means if you break up Apple, if you close it down, liquidate the assets, you'll end up with 65 billion, theoretically. Now, the thing I really want to draw your attention to, Moeed, on this this set of accounts, and this is a strong balance sheet. I mean, these guys are, they are flying. They are absolutely, I mean, they're going 100%, 100 miles an hour. It's really, really good. But it's looking at the cash position of this business. So if we look at the cash business, now, if I said to you, how much cash have they got? You're probably sitting there thinking, Ted, I reckon they've got about 38 billion. And you'd be right. They got 38 billion of cash and cash equivalents. However, actually, if you look, what they've also got is this number here. These are marketable securities, and marketable securities are bonds. Okay. And without going into the detail of what a bond actually is, some of our listeners will know what it is, some may not. A bond is effectively a place you can park cash that earns you a little bit of extra interest. So the way to think about marketable securities or bonds is a bit like a deposit account. We open our deposit account to park surplus cash because it earns us more than our current account. So when we talk about cash, we're talking about these two numbers here. So that's 38 plus 52, which is in my head, what's that, $80 billion. Okay, so we've got about $80 billion of cash just sitting there doing nothing. So what's really interesting about this balance sheet, Moeed, is this number here. Now, this number here is also marketable securities, but you'll notice that these marketable securities sit under non-current assets as opposed to current assets. So the top marketable securities, the top blue line, are loans that mature within a year. So we're going to get the money back within the next 2 or 3 months, for example. The bottom one, the non-current marketable securities, are loans, are bonds that mature more than 1 year a year, maybe 2 years, 5 years, 10 years. So that effectively means that we're going to get the money back from the person we've lent money to in 5 years' time or 10 years' time. However, these are marketable securities. It's not a loan, it's a bond. And a bond is tradable, which means that you can sell this like that. So the bond markets are open. So these marketable securities are basically just another word for cash. It's a place where we park our cash. So if you think about you have a current account and a deposit account, your deposit account earns you a little bit more interest. It's where you park surplus cash. So for Apple, we should really be adding in this 101 billion into our 80 billion to find that they've actually got 181 billion dollars of cash sitting on the balance sheet, effectively doing nothing. Now, what Apple have actually done is that in order to return that to the shareholders, what they've actually done in the past is that they've borrowed money in order to return through the share buybacks, and they've borrowed that money in order to repatriate the cash, because the cash is stuck overseas and they can't get it back because of tax implications. So really, when we're looking at this balance sheet, we need to kind of, scrub that one from the non-current assets and say that they've only got 80 billion in non-current assets, which kind of makes sense because it's, a couple of blokes with, in mum's attic with their servers. It's a bit more complicated than that, obviously. But, really, Apple is just, they don't make iPhones because that's all outsourced. All of their supply chain is outsourced. And what we should really be doing is change this one into a two. So it's 243 or 244 billion dollars of current assets and only 80 billion of non-current assets. And that means that if we were to revisit our liquidity ratio, comparing this number to our current liabilities, you can see that they are massively liquid. So Apple, very, very strong cash flow, very strong balance sheet. Really, these guys, they're like the Pablo Escobar of the corporate world. You may remember Pablo Escobar in Narcos. He was the guy who got so much money, he didn't know what to do with it. He was burying it in the garden. Well, it's exactly the same as Apple. They've got so much money flooding into the company, they almost don't know what to do with it. So this is quite interesting. So if we go back and look at the cash flow statement, what we notice in the cash flow statement in the investing activities is these top 3 lines. So these top 3 lines indicate the purchases of marketable securities, the proceeds from the sale of marketable securities, and the proceeds from the maturing of marketable securities. So in effect, this is me buying bonds, this is my bonds maturing and I get the money back, and this is me selling these bonds. Well, the way I see these 3 lines is really just putting money into a deposit account and taking money out of a deposit account. putting money into a deposit account isn't investing, and taking money out of a deposit account isn't divesting. So what we should really do, I think, is to revisit the cash flow statement, but we should revisit the cash flow statement excluding those bonds. Those bond movements effectively. And there we see a much more interesting view that actually, if we eliminate those particular numbers and we look at the investment activity, you can see here's the kind of property, plant and equipment. So this is really the big line that's going on, and that Apple is actually investing. So here it looks like they're divesting, they're creating money, but that's really driven by their movement in bonds, and is effectively a misnomer or an irrelevant number. So I guess the point here for Apple is that, you know, when you're looking at a set of accounts, you know, it's really important that you do kind of, you know, you peel it back. You know, what it looks like on top is not always exactly the story that's going on. And Apple has a very clear story of, you know, basically being a company that's just generating tons and tons and tons of cash. Interesting enough, their working capital requirement, you know, another reason for them generating cash is that it appears that their accounts payable days are about 95 days, which sounds a long time to me, but then that's Apple probably using its negotiating power in order to get that. So inventory days are only 9 days. It's very, very quick. The accounts receivable is 26 days. Sounds about reasonable. Lots of retail where people are paying up front. But then 95 days paying their suppliers means that they're getting the cash in before they pay the cash out, and that's good for our cash flow. So I guess the question then comes down to, you know, what are they worth, and are they worth it? So if we go and have a look at the stock price at the moment. So here we see the market cap and the PE ratio. So they are trading on, according to our chart here, 36 times earnings. That's about right. I'm on about 39 times if I plug the numbers into my spreadsheet. So 36 times earnings, that's a yield of, you know, around about 3%. It's expensive, but we're not in Tesla territory here. So this is expensive, but it's not crazy expensive. You mentioned a $1 trillion company. It's now nearly $2.25 trillion, so 2.241. And if you remember the balance sheet, we had 65 billion of equity, which means that, you know, this company is pretty much all goodwill. Okay, so you're not really buying the assets if you buy Apple. You're really buying that future income stream. So very good products, very compulsive products. The sales are continuing to go up. You know, China is still a sort of a very big untapped market, very aspirational Western brand. You know, as long as they can maintain that brand dominance and get that pipeline, get that next star, what's going to replace the iPhone? That's the key question on people's lips. So if Apple can kind of reinvent and can be relevant in the future, then this, you know, I have bought stock in Apple. I bought it a while ago. It has gone up, but even then, when I was buying it, it was pretty expensive. So, you know, I recognize that it's an expensive company, but I'm comfortable to kind of, you know, to buy at this level. I'm not all in, but I certainly have it sitting in my portfolio.
So if in your opinion, if they are going to reach a $3 trillion valuation, do you think it's still expensive, or would that be a decent deal?
Oh no, absolutely. If they're gonna reach a $3 trillion valuation, well, I mean, you know, if it's trading at 2.241 and it reaches 3, then you know you've increased your investment almost by 50%. So you know that kind of makes sense. The real question you're asking here is in terms of the earnings. You know, if the valuation goes to 3 trillion without any change in the earnings, it just makes the company more expensive. But if the earnings drive the valuation, then it doesn't necessarily become more expensive. So what you're trying to do is to think about, you know, what's driving the valuation? Are people buying and then the earnings catch up, or is it that the earnings are driving the valuation? So in Tesla, for example, it's not the earnings driving the valuation. It's people's perception of the future. They buy the stock, they say, yeah, let's pile in the valuation, and it becomes very, very expensive. And then the earnings need to catch up. So here, the earnings are, you know what, they're not a million miles away. I think the S&P's trading on a cape of 30. I'm not going to go into cape right now, but you know, this looks, it's expensive, but it's not massively expensive compared with the market. You know, and I can find, and we have in some of our other videos, we found stocks which are much, much more expensive than Apple. So I'm sitting there thinking, you know, it's not fill your boots. We haven't uncovered a kind of, you know, a nugget where we're going to make our fortune. On the other hand, you know, the stock may go down, but I can't see you losing your fortune unless suddenly somebody decides that, I don't know, iPhones cause brain cancer or something, in which case you could probably see, you know, a company would take a, you know, a very, very big hit indeed.
Yeah, very interesting. So it sounds like almost as if it's a steady investment, right? It's in your, how do you call it? It's not your growth portion of your portfolio, but it will certainly be a good bet, a steady and stable bet of your portion of your portfolio.
Yeah, I think that's a fair assumption, and it's just recognizing that, you know, they've got to come up with something new. You can't
Yeah,
live on the iPhone forever. You know, technology today is changing rapidly. I don't know when the iPhone was launched, something like 2006 or something.
yeah,
So you
13 years
kind
ago.
of think, you know, what have they delivered since then? You know, what has Tim Cook actually delivered? And don't tell me about the watch or the iPad. You know, there's nothing new coming out of Apple. You know, it's all just getting better, and getting better is fine, but we kind of need something new, and that's really where the valuation is justified. 18 billion of investment. What are they investing in? Driverless cars, driverless technology, 5G. You know, all of this is a real potential for Apple. So, you know, they certainly aren't beat by any means. There'll be a lot of very, you know, secretive stuff going on, and hopefully some exciting products coming out in the near future.
Yeah, they cite that as, the analysts cite that as part of the reason why they suspect it will probably reach a $3 trillion business. So this was really interesting, Ted. You know, what are your thoughts, everyone who's watching this? Again, as with other people that have done this. So if you have a company that you really want to see our analysis on, leave a note in the comment section, and we'll do that. We actually received two new companies just this week, so we're going to be releasing those companies in a few days' time. So your voices are being heard. So like, share, subscribe. Ted, thank you for a great video. Really interesting company, and a popular company, of course, to look at. And we'll see you on the next video. Thank you.
Good to see you, mate.